Hello there, and good afternoon, ladies and gentlemen, and thank you and welcome for joining us on the latest Primus Live webinar. Just so you know, we're about to go live literally in 5 minutes. I'm excited. I hope you're excited. See you in 5 minutes. Hello there, this is James, and thank you and welcome for joining us on the latest episode of us Primus Live webinar series. Now, before I introduce you to my host, or my co-host, shall I say, and the topic of the day, please remember these little live broadcasts are for educational purposes only, and in no way whatsoever should be taken as advice. I always suggest you do your own research and do your own due diligence, and of course, know the risks at hand before entering any trade. Now, let me give you an intro to my co-host today. My co-host is Kaia, and she is our head of investment research at FX Primus. Before she worked with us, she was a portfolio and investment manager with exposure to both public and private markets. Before we were lucky to get her, she worked as a senior investment associate at a hedge fund in Singapore and was a vice president at Bank of America, Merrill Lynch. Please say hello to Kaia. Kaia, my dear, how are you?
Hi, James. I'm good. Thanks for having me. How are you doing?
I'm doing really well, thank you. Really well. And the pleasure, as always, is all mine. So how's your week been?
Week has been good, and our regular viewers can see that both of us have finally sort of gotten into our winter coats. So Cyprus is getting slightly cool as we are nearing Christmas season.
Damn right. And I love this time of year because I'm very much a suit person. I love wearing my suits, and one of the negative things about living in Cyprus is it's not really suit weather. You know, you would actually roast alive if you put on a suit. But now, like I say, you know, it's getting colder, it's raining, and I can finally put my suits on. So I'm very pleased about that. Very pleased.
Have to say, I prefer the sunny side of the weather, but nevertheless, it's nice to have a bit of, you know, colder weather every now and then.
Absolutely, it's nice to see a bit. It's nice to see a bit of rain. You know, a bit of rain. Now, first of all, I think, like I said, we'll get onto the topic of the day a little bit later because it's an interesting topic and it is a very important topic. But I think we want to start off with talking a little bit about what's going on in the markets, because and we can tie it into our topic, obviously, because let's face it, over the last couple of trading sessions, we've seen an awful lot of volatility and activity. So let's have a look. Let's bring up my MT4 platform and share that. So first of all, we have the S&P 500. Do you want to share roughly what's sort of happening with S&P at the moment?
Sure, I'm just opening up my own map with my own chart in parallel. And just to give a bit of a context why we're bringing up the markets. So today's topic is risk management. And we've seen a lot of volatility on the markets, let's say with the last couple of months, partly from, you know, the coronavirus cases spiking and also from the US elections. So we would like to talk a bit about the asset classes, how these have been performing, and then bringing that discussion into our risk management topic.
Yeah.
So with no further ado, I'm just going to pull up myself S&P 500 again. So S&P 500, just for those who don't trade US equities, is a index that consists of 500 biggest companies in the US by market capitalization. And this this index has been hitting all-time highs. And we saw another all-time high last week when we broke the resistance levels of, I would say, near 3580. And now with this resistance being broken, I would say that we're going to see S&P moving higher as there's no other resistance in place. And those who use moving averages as their sort of momentum indicators, you can see that all moving averages, so those who know, we like to use 8, 21, 34, 50, and 200 day. These are all pointing to the bullish direction. So from market risk on sentiment, S&P is the perfect index to show that we are probably going to see higher equity prices going forward. Another asset class I would like to talk about is maybe DXY or US dollar.
Yeah. Dollar index, yes.
Okay, I'm pulling that one up as well. So DXY is also an interesting one. DXY is basically the value of US dollar, but measured against a basket of different currencies.
That's and the basket of 6, isn't it? Basket of 6 currencies. Yeah.
Basket of 6. Yeah. And predominantly that's of euro. Euro is, I think, 55 to 60%. So predominantly it's Euro USD that we're looking here. But US dollar tends to have a bit of inverse correlation with most risk-on assets, such as US equities. So generally, when we see equities performing really well, we're going to see US dollar performing, slightly lower. And as we can see from this chart, we're actually hitting again swing lows. We're very close to what's the current price? I see 92.08. So we are really on the lower end of the trading range for US dollar. And all the moving averages are again pointing in bearish direction in this case. So I don't know, James, do you agree that if we break, let's say, 91.5, 92 level, US dollar may actually hit 80 even?
Well, like I say, you rightfully said it. It is approaching the lows. If we look at some sort of key levels, I've got this on a daily here. I would say that is a key area of interest to watch, definitely. And it would be something, I think, if it does break, then we are going to see potentially not trading advice, of course, everybody. We could see further declines greatly on that. So I would agree.
Yeah, but point being is I find US dollar measured as DXY is again a great indicator showing that most likely there's a lot of risk on sentiment in the markets, and US dollar may not be the most favorable asset at this point. And
as I said, I totally agree, because obviously the whole point with the dollar index, obviously, because you say it's the basket of 6 currencies consisting of euro, majority sterling, Australian dollar, etc. If there is risk appetite in the market, then obviously the euro performs slightly better, the sterling can perform slightly better, etc. And the dollar gets weakened because, as we know, it's part of the special safe haven gang. So yeah, very much so. That's greatly influenced by that. So yeah, I think, like I say, we are, as you rightfully said, with the S&P 500, we have seen a big boost in optimism. And we discussed this the other day with the US elections. Not because of that, but really because of the hope of we've got free vaccines now, potentially. So that is giving a boost to the market. So yeah, this one will be the one to watch on the downside, I would agree. If we keep this bullish run going, definitely.
Yeah, I agree. And the last one I want to bring up is gold.
Yeah. And here we are.
Again, another safe haven asset. And gold has been hitting all-time highs, like many other assets this year. I think we highest probably what was this month here? Is it
this is
September,
on a daily,
correct on the chart. And gold has really fallen between the cracks within the last couple of trading sessions. So gold is actually very close to hitting 200-day moving averages. And those who trade moving averages, they know that 200-day moving average tends to be a bit of like a line in the sand. Once you go below 200-day moving average, you can really hit the bear territory. From that perspective, asset prices are going to move very rapidly, and a lot of the institutional investors are going to get out of that trade. So gold is definitely something to keep an eye on. And I think that this weakness in gold came as a big surprise for many market participants, because everybody's still expecting us to see an inflation, and gold tends to be an inflation hedge. So it seems to me, looking at market commentary, that a lot of the people were surprised that gold is actually performing so poorly. And I think a lot of the traders got burned because they didn't have in place their stop losses for gold. So meaning they didn't risk really well.
Exactly. And that leads us, just before we go on to that, it's brilliant lead up to that. I love it, because we're about to talk about risk management. I agree. I think gold, for me, is, and I am a gold trader. I'll be watching it very, very closely, because, let's face it, it's benefited greatly with the outbreak and the lockdown back in March onwards. But now with this optimism, we're beginning to see it's losing its shine a bit. So they're greatly lost. But you're right. The recent drops of the last day, as Kaia rightfully said, if you didn't have a stop loss or didn't have risk management, you might have got hurt pretty badly, which leads us on to our topic of risk management and the importance of risk management. So let's bring up the slide. Here we go. Right. First of all, of course, the big question is, what is risk management? What would you?
I mean, people define risk management differently, but for me, risk management is really having a plan, having rules, and adhering to those rules.
Absolutely.
So people like to think of trading as this being gambling. Like you go to a casino, you put some money on black, some money on reds, and maybe you're going to win, maybe you're not going to win. But actually, trading really is having a set of rules, following these rules, and if they don't work, you tweak them. and until you get them to work. So for me, always risk management is actually setting myself a framework, and I always write these things down. I have a trading journal, and really making sure that my emotions don't get the best of me, that I do try to adhere to the rules.
Absolutely, because I say, the thing I find about risk management is that it's so overlooked by newbie traders, but also really experienced traders. They don't really think about it or take it into account. I get that, because what we're going to be it's more practical, as you rightfully say. You take the emotion out of your trading. When you're talking about technical analysis, you're talking about fundamentals. There is a little bit more excitement to it, if you know what I mean. There's a lot more stuff you can talk about: moving averages, Fibonacci retracements, RSI, and things like that. It makes it a little bit, and it's visually stimulating as well. So this is why I think a lot of people ignore it, because they don't engage with it so much, because it's really taking the emotion out of trading. And I think that's why so many people, and one of the main reasons I think so many people fail or are unsuccessful in their trading, is they don't take this seriously or spend the time to study this as much as they would technical analysis or fundamental analysis.
Yeah, I agree. And I think that's the big difference between the retail and institutional traders. So retail or individual, I should say, maybe. So individuals probably, they don't have that mandatory framework to stick to their rules. But institutional traders, those, let's say, for funds or for banks or whichever family offices, for them, the systems are the ones that actually enforce them to have the controls in place. You can never exceed your, let's say, your P&L, your profit and loss sort of size. You can never exceed your trade size. Once you hit certain level, the system forces you to get out of the position. So I think that the institutions have realized that you can't manage people's people's emotions. So they've put controls in place in the system to make sure that certain rules are followed. And us as individual traders probably can't afford those systems, but that means that we have to be even more stringent with our own rules and making sure that once we hit certain limits, either we're out of the trade or we're in the trade, or we take certain action.
Yeah, exactly. Or otherwise, you become gamblers, don't you? You become like a gambler.
Gamblers, yeah. And go ahead.
Yeah, so the question is, if we move on to the next slide, is what's the main difference between a gambler and a trader? For example, and we really sort of touched on this already. Gamblers tend to get excited through the action in the market, don't they? And it's more of the thrill of winning than actually sort of the it's the excitement of it and this thrill of winning than actually be thinking. They're also more reactive, not proactive, and they tend to increase their trade sizes to get back their losses. If they make a loss of 100, they try and increase it because I want that back straight away. That sort of thing. They look for the big wins. Not instead of thinking on a practical sense. They're very, very emotional. As opposed to, as we said, a trader. They have trading plans. They focus on the net liquid value. Risk exposure is always consistent. They never risk more in different trades. They always risk the same amount. They analyze their trades and they adjust to the contract sizes if needed. And more importantly, and this is the big thing, I think, is the long-term plan. Long-term plan thinking.
I agree. And again, thinking about trading, the hardest thing to do is you have to be a machine.
Yeah.
You really have to be like a machine, meaning that you know what has to be done. You remove your emotions. And unfortunately, us as human beings, we are subject to so many different biases. And I believe, James, that in the pipeline we have a webinar talking about the psychology of trading. Yes. And I think we're going to talk about different biases, behavioral biases that people are just prone to have. And the gamblers probably, they are anchoring bias, gambler's fallacy, all these type of things that they just can't put aside. Whereas professional traders and experienced traders, for them, what's important is really, like I said, increasing the net liquid value. So this means that you don't have to win every single trade, but you have to win most of them. And the focus is to treat the losses as they are business expense.
Yes.
Business is nothing personal. It says nothing about you as an individual, but it's just purely the business expense.
I love that, actually. I love that explanation. Treat it like a business expense. That's brilliant. No, I totally agree. I love that. I love that saying. Really good. But no, you're absolutely right. And I think again, we'll go on to the technicals and things like that. Again, you're right. You have to treat it like a machine and not get blown away by the excitement of a moving market watch, moving trend lines, or moving this or something. The candlesticks doing that. You need to try and get rid of the excitement and the emotional, so you can actually approach the market like a machine, as you rightfully said. Now, one of the methods I think, which is quite popular, is the raw to risk ratio, um, which is our next slide.
Yeah.
Um,
Reward to risk ratio is just one of the ways how you can manage your potential loss.
mhm,
So it's basically the unit of reward you can
mhm,
have for a unit of risk. And
mhm,
3 to 1 is a pretty common way, pretty common reward to risk ratio used. More conservative ones can have maybe 1 to 5. But
mhm,
point being is that you really don't take too much risk for any additional units of reward that you can have. And the
mhm,
table here I find is quite self-explanatory. Basically going through that if you risk 1,000, you could make a profit of 3,000 from the same amount.
mhm, mhm. I mean, that's the target. If you're willing to lose 1,000, you should be, that your plan is to make that 3 times more. Okay, because
Correct.
obviously, if we take the example of this, there's 6 trades here as an example. Say you're 50% successful and 50% unsuccessful in your trades. 3 of the trades would be a loss of 3,000. Because you have the raw to risk ratio of 3 to 1, if the other 50% of your trades are successful, then obviously you would be making a profit. You would have a profit of 6,000 in general. And it even works in this way. Even if you have less than 50%, so you had, say, 4 losing trades, okay, you still potentially would have a profit of 2,000, wouldn't you? So that's the method, which I think quite a few traders try and imply, and it's not a bad method. But like you rightfully said, the rule of the thumb is not 3 to 1 necessarily. If you're a little bit more aggressive, you look at 5 to 1 or 5 to 2. But it's just having that sort of structure in place with your trade, I think, which is more important than anything else.
And this has to be very hard cut rule. Like once you hit a
Hmm.
certain loss, you eliminate the trade.
That's
There's
right.
there's no emotions. Perhaps it's gonna reverse. Maybe tomorrow the market is better, but my
Hmm.
analysis was correct. Analysis is
Hmm.
only part of the trade. I mean, there's still market moves that you can never control. So once you hit a certain loss, that's it. You're
Hmm.
done. You cut the legs as early as possible
Yeah.
of any losing trades.
Now, that I think that is a key point actually you made there, because one of the fatal mistakes a lot of people make is they revenge trade. They may set a stop loss, but then they get emotionally attached, maybe increase their stop loss, or maybe increase the amount of money, the risk of their trade, or go against, jump in again to try and reclaim their losses. The point of whole raw to risk ratio is, like I say, whatever happens first, you hit your profit first, or you stop, or your loss first, whichever hits first, that's the end of the story. You then leave the market, close your laptop, close your phone, close down your PC, and walk away from it, no matter what the outcome is. But yeah.
And I would say there's also the flip side of it. There's also taking the gains of each trade, meaning
Mm,
that you don't have to sit on a winning trade indefinitely. There's always beauty of also taking the gain at certain points when you think,
mm,
okay, this is what I wanted to achieve, and I'm just going to sell because whether you like it or not, there's still some sort of anxiety at least involved with each of the trade. At least the fact that you have to look at a trade every day when you open your trading platform or MT4 or whatever you use. So for me, I always set myself the profit gain and the profit sort of target and the loss target.
mm, mm. Yeah, again, and then you stick to it, don't you? That's why you're successful.
Do my best.
We're only human, but yeah, no, fair enough. No, you are successful. But look, moving on to the final slide, and this is the most important thing I think, which can help you with your risk management, is understanding that losing at the end of the day is a part of trading. It's impossible to have 100% winning trades. You are going to have losing trades. But the whole point of having losing trades is then understanding what went wrong or how you can then improve on those losses. So analyzing your trading, that is the key, even the successful ones and the unsuccessful ones.
Yeah, and trading journal can be something as basic as, an Excel spreadsheet.
Yeah.
You write down every single trade. You write down the logic, why you enter this trade. You enter the details such as, the entry point, the date, and then the most important thing is what is my stop loss? What is my profit taking if you choose to, follow the same logic? And is there anything that may change the reason why let's read this way, let me rephrase. What could force me to get out of the trade even if I don't hit the stop loss? Let's say if the reason why you got into the trade changes, but you're still, let's say, above your stop loss, I would get out. Meaning like I need my thesis to follow until the last minute. If it changes, then I'm going to exit that trade.
Absolutely. I mean, it's incredible amount of discipline you put into place, and say you do really need to sort of look at your losses and learn from them, because as I often say in other educational stuff I do, failure is often the best teacher. And that's
unfortunately, you're 100% right.
I mean, like I say, when you look at your losses, you got to ask several questions like, am I sticking to my trading plan? Am I being disciplined? Do I react differently when I'm in a loss? So, for example, what was my decision-making process to get out of that losing position? What was my decision process to get out of my winning position? And did my brain or did my my level of thought were different with that? And more importantly, do I hold on to losses for too long? Those are the sort of questions you need to ask yourself, and that's how you can start to learn how to really structure a proper trading plan, which may possibly work for you. And only by doing it that way, I think, is that you can learn from it.
And I think what's very important is if you don't write these things down, you tend to forget them. You tend to forget, why did I enter a certain trade, especially if you trade, actively. And again, I think that there's a sort of more to learn if you trade more actively, because that's just experience that you sort of accumulate. And you tend to forget, what was the logic I enter one trade, or what was my stop loss? So having this in writing is just brilliant. And you can do it on a piece of paper, you can do it on Excel, whatever somebody prefers. For me, I just have an Excel sheet open and I constantly go through my logic. And what happens is that I enter some trade multiple times using the same logic, but perhaps I exit at some point, then I get back on. And, it's good to go back and forth. And it really, forces you to analyze and think through what is the reason why I want to, trade euro or trade yen or trade S&P 500, for instance.
Yeah. I mean, I used to use my trading journal not only to learn from, because my trading journal is almost identical. Again, I have it on an Excel sheet. I have the date, the instrument, the entry level, stop loss, take profit, my reasons behind it, and the outcome, so I can have the record of it. But the other reason I used to use a trading journal, because I found it slowed down my emotions, if you know what I mean. I wasn't looking at a chart on my platform and then seeing something and clicking something and reacting to it. I was actually slowing down my thought process, getting rid of my emotions and thinking about it logically. And because my rule of thumb used to be, before I entered the market, every single box had to be completed before I entered. So even before I clicked trade, I knew my entry, my take profit, my stop loss, and I had an understanding reason behind it. And unless I had those boxes filled out or completed, I wouldn't do anything. Because I just feel that it also helps you with your discipline of taking the emotion out of your decision-making process. So really,
that makes perfect sense. Yeah, exactly. I mean, and really forcing yourself to stick to it. And if you happen to have a friend or a fellow trader, exchange your trading journals, discuss these things. Exactly. The best way to learn is sort of in a group, or at least go through the thinking process.
Yeah, I mean, that's a great idea, because then something you may not notice, your colleague or your fellow trader might be able to notice it for you, and vice versa. So a fresh pair of eyes. But yeah, trading journals, both seriously recommend. Both of us recommend you seriously start maybe keeping a journal and learning to use a journal, because that will potentially make a lot of difference to your trading.
And moreover, let's say if you're sort of on a winning streak every now and then you tend to be a bit more optimistic, most likely, or the vice versa. Let's say if you've been losing a lot of trades, then the same gamblers aspect may bring in that, oh, I want to have bigger size trade because I've lost that much money. No, that's not going to happen. If you have your journal, if you have your rules, you just see, okay, no, this is how I trade. I'm not going to go for that larger trade because I've lost maybe 3 trades in a row now.
Yeah, absolutely. It can make all the difference. It really can. It helps you with discipline and learning. Right, we've got a couple of questions and sent in by our. Once again, guys, thank you so much. I would just say thank you for writing in with questions. It makes all the difference because at the end of the day, these little live streams that me and Kaia do are for you, and we need to know, how we can help you, how we can put the content and the information together, which is what you need. Plus, it's so nice to know that we are being watched and being interacted with, and we are making a difference. So the first question has come in, and the question is how to manage my risk. And I think we've answered that already, really, haven't we?
I think so. We've covered the main points. I think we've covered this question pretty well. If something is still unsure, if the person who asked is unsure, feel free to reach out to us. We will try to give our best.
Yeah. Well, like I say, managing risk, definitely go back and watch the rest of this video. But obviously, trading journal is one of the most important things. So certainly have that. Again, a very similar question again. Please send me some detailed points on how to manage risk, because I've lost some of my investment capital. Again, like I say, like me and Kaia has stressed, start a trading journal. Not tomorrow, not next week. Start it today. That would definitely help. How to minimize losing your money in trading. Again,
trading in place.
I know, trading journal. We should just sell trading journals. We'll make a fortune. Trading journal. Yeah, like I said, minimize losing your money in trading, but trading journal, maybe look at some reward risk ratio as well. That, what we discussed today, that could be a factor which can make all the difference as well. So look into that. Another question, I recently invested. Hello, I'm a beginner trader. I recently invested and everything is looking better, in exception of how I can handle losses. How can I avoid emotions after losing? And how does one keep his losses small and wins big? Because to my understanding, as a trader, you need to keep your losses small and winners big, but I find it difficult, and how to avoid over trading. Great question.
Firstly, I love the question. Thank you so much. So thorough. I'm going to start from the last part of the question. How to keep your losses small and winners big. You don't have to do that. What you have to do, you have to keep your winners consistent. And it can be a small win. I mean, no trader ever wants to win, let's say 100 and lose 20. No, they want to do it gradually. They want to lose 20, maybe win 30, lose 10, win 40. And that's how traders think. You don't have to win a lot, but you just have to win constantly and consistently. And ideally, the ratio what I like to have for my gains is 70%. So meaning I don't have to win 100% of them. I'm totally happy that some of it goes to my let's say accumulating experience bucket and teaches something about me, about my trading style, about the markets. And I just accept those, and that's the joy of getting better. Like you said, James, we unfortunately learn from our mistakes more than we learn from our wins.
We do. The failure is the greatest teacher. But you're absolutely right. I think like you said as well, it's a long-term game. You've got to think it is a long-term. You've got to look at this as a business. Brilliant what you said around business expenses for losses, and accept, more importantly as well, that losses is part of trading. You will lose at some point.
It is.
It's just controlling them and making sure that you can keep the emotion out with the next trade or the next market idea you may have. I think I've got one more
part about this question. I'm just gonna. There's one more section in this question which was asking about emotions and how to handle the losses. What we want to do, as we mentioned before, we want to do a next webinar, probably in 2 weeks, maybe 3 weeks, about the psychology of trading, and we're going to cover managing the emotions as a part of it. So please do register for that one. We're going to send out the email probably in a week or maybe 2, and that's going to be a deep dive into the psychology of trading. So looking forward to everyone joining.
Yeah, that's going to be. I'm looking forward to that. I'm going to talk about one of my favorite topics when it comes to that one, which is the battle of hope and fear. And everybody who's known me over the years know I love talking about hope and fear when it comes to trading. Okay, there's another question, which I think it basically wants us to go over the trading journal again. A great question. This is live on air as well. What are the check boxes you need to tick before you make a trade? So again, going back to what are the boxes we complete on our trader's journey before we do it?
Okay, so for me, it's clearly the trade itself, buy, sell, the pair, the instrument. It's the thesis of the trade. Why am I entering this trade right now? Is it fundamental? Is it technical? Is it contrarian? Whatever. Yes. Then for me, what I like to do personally is to add market sentiment. So market sentiment is another topic we can cover at some point. In fact, those who are premium users of FX Street, I'm also a contributor to FX Street. And on December the 1st, I will do a webinar there talking about how to gauge market sentiment. So I like to tick that box as well, just to see what's happening on the market. Then it's the entry point, exit points, both the upside, the downside, and then just details, let's say the date. And for me, again, the important box is that what part of the thesis must be unchanged? What is the thesis? What is the core of the thesis? And if that changes, that also forces me to exit the trade. I'm not going to wait for the stop loss. So these are the main things for me. Anything from your end to add?
Yes, like I say, that my trading journal, the boxes I have to complete. Obviously, the date, instrument, short or long. Obviously, the entry level I predetermine, the take profit I predetermine, and the stop loss I predetermine. I do my analysis, my explanation. Like I said, it could be sentimental, fundamental, or technical, or could be some other reasons I may be thinking that is. And I have the result. I have to complete all those boxes, obviously bar the result, before I go and do any trade. Because that helps me make sure I know where I'm going to get in before I get out of the market, or get out of the market before I even get in, shall I say. And it helps me take the emotions out. So those are the sort of tick boxes I tick. And that's what's important to me. Another question I have, which I think is related to maybe another webinar episode we've done in the past, and we'll do again. I think we're doing a technical analysis one as well, aren't we? On next week, isn't it?
We are next Wednesday, same time, same place.
Same channel, same time, yeah. And this question is, I think it's going to be more related to that. How does one make a decision to go long or short? That's a big question.
That's a big question. That's a big question. I mean, first of all, what I recommend is go to YouTube, to FX Primus channel. Go through our previous lives. We've done one on technical. We've done one on fundamentals. I mean, the decision to enter the trade really depends on your trading style. What is your trade? What are you trading? Why are you trading? Are you Are you a momentum trader? Are you a contrarian trader? Are you a fundamental trader? It's very hard to give a short answer to that, but I encourage everyone to go through our previous webinars, because we've covered some of these topics before. Absolutely, and we'll be discussing more of these topics and more of the things a little bit later as well in other episodes. I have another question from an individual who's watching us right now. How do I stop my emotion? Again, I think we've already discussed that. One of the best. I mean, look, stopping emotions in general is difficult because we're human, we're emotional. But one of the things which helps me, and I think Kaia would agree, is a trading journal, because doing that slows down your thought process, takes away the excitement as well. That helps you stop your emotion. Again, I guess you agree with me on that. I agree, but I would just say that, managing emotions is sort of a skill like any other. It just requires practice. And there are some techniques one can add to get better at it. And, again, that will be part of our trading psychology. But just to give a bit of a hint, such small things as controlling your breath, doing controlled breathing works wonders. You can Google, Navy SEALs use it to calm themselves down. So as individual traders, we can also practice, certain calming techniques to pull the emotions out of the trading. Yoga. Would you recommend yoga? Love yoga.
All right, one last question. Again, this is from an individual watching this live. I love. Don't you love it when they send in questions live? It's brilliant. How do I build a trading journal? For me, I just do an Excel sheet with those columns. You know, dates, instrument, direction, entry, stop loss, take profit, explanation, and profit, and it's a simple table on an Excel sheet. Do you do something similar with that? I believe you do, don't you?
Yes, easiest.
Yeah, easiest way. Keep it simple. There's no need to be overly complicated. The only thing I would say is make sure you're disciplined and you do complete it, because then you have a history, and that's the only way it's going to be useful. Okay, we should definitely start selling trading journals. We're big fans of them. We keep, wear a t-shirt saying "I love trading journals." Yeah, or a little badge or something.
Part of FX Primus's merch maybe going forward.
Yeah,
Maybe we can figure something out for our premium clients.
There you go. I have an idea. Sign up today, you get a free trading journal. There you go. Yeah, I like it. Right, brilliant. Thank you so much for those great questions, everybody. I really appreciate it. We both really appreciate it. It makes all the difference, because don't forget, these little live broadcasts are for you, fine people out there. And we do know that. And please keep the feedback coming as well. Kaia, there's our latest episode. What do you think?
Loved it. Loved the questions. I love the engagement. And a lot of the topics that we cover are coming from you. So please continue sending us emails with the questions, and we will put the topics together, around the sort of theme that you guys are looking for. And as we've mentioned already a couple of times, next Wednesday, we're going to have the second webinar about our technical analysis indicators. We're going to cover about 3 to 4 additional indicators, and maybe we're going to give a brief overview of the markets as well as we did today. And then most likely in 2 weeks, maybe we're going to talk about the psychology of trading. And I'm just going to mention again that on the 1st of December, there's the FX Street webinar about market sentiment, only available for premium users of FX Street, not FX Primus. So looking forward to, seeing everyone on that webinar as well.
Brilliant. Make sure you put that on your diaries. 1st of December, yes, for the FX Street one.
1st of December, and then 2nd of December for our internal one.
Excellent. Okie dokie. Well, let's sign off. So again, a big thank you for everybody watching, and really appreciate again the interaction. Please keep it going. We both really enjoy doing these little episodes, but we enjoy it more when we know that it's reaching you, and it's hopefully making a difference to your trading. So, Kaia, do you want to say goodbye?
Thank you everyone for joining. Have a good week ahead.
Excellent. And before I sign off, guys, remember, ladies and gentlemen, remember, these little educational episodes are for educational only, and no way whatsoever should be taken as advice. I always suggest you do your own research and do your own due diligence, and know the risks at hand before entering any trade. Till next time, every single one of you out there, trade safe.